Welcome to the Property Regeneration Podcast. In this podcast, we discuss innovative products and services that meet either local, social, technological, environmental, political, and legal needs within the construction industry or property market. Introducing your host, a property developer and investor, Rachel Gross.
Hi everyone, welcome back to the Property Regeneration Show. This week we're discussing the affordability of mortgages in the property market for first-time buyers or investors and seasoned or portfolio landlords with Catherine at London Money within their office in Victoria, London. We'll be expanding this conversation later in the year with Catherine and her colleague, including the topic of adverse money. So if you have any questions you would like me to ask relating to property finance, feel free to email us your questions on contact@propertyregeneration.co.uk. Thank you. Welcome back, everyone. Today we're looking at things at a slightly different angle. We're looking at the financial side of property, and we've got the lovely Catherine here today from the
London Money Group, but specifically London Money. Hello, everybody.
Hello, Catherine. So do you want to tell people a little bit more about yourself and where you sit within the organisation, and then probably carry on with a little bit more about the London Money Group?
Absolutely. So my name is Catherine Beaumont. I've been with London Money for nearly 3 years in December, having qualified not long before that, but always having worked in the mortgage industry sort of on an admin level.
Yeah.
I joined London Money in December 2016 and really haven't looked back since. So London Money is kind of our flagship office within the London Money Group.
Yep.
We have brands now appearing all over the country. We're pretty much north at the moment, but we're slowly gathering pace down south as well. So my role within London Money is a mortgage and protection consultant, and that's anything from residential, second charges, buy-to-let mortgages, and also I specialise in protection as well. We work not only within London, but also all over the country, just helping clients obtain their mortgages and giving advice and hopefully finding them a great mortgage deal.
Okay, brilliant. So why was the Money Group set up, hence London Money, and when was it founded?
So Martin Stewart is the director of London Money, or the Money Group, and actually started as London Money. And then I think he saw an opportunity to sort of branch out with the brand. We think we've got a great brand, so we seem to have, we actually have Yorkshire Money, Manchester Money, so it's quite a nice brand with the word money on the end. We have adverse money, we've got divorce money coming a bit later on in the year. Martin has been in the industry for years. He probably doesn't want to tell he probably doesn't want me to tell you how long, because then you'll know how old he is.
Yes.
But I think we were established here around about sort of 2011, and we have 7 advisors with us at London Money, but of course our network is growing across the country. So look out for the sort of money brand popping up everywhere.
We'll do indeed. So when we talked earlier prior to this discussion we're having now, we highlighted that it would be good for you to perhaps enlighten our listeners a little bit more on affordable mortgages and the current trends that are there at the moment, I guess, in a spectrum throughout the whole UK, and how much that differs or is, if it's leading in any way in the London market.
Yeah, so obviously the London market has been hit quite hard, specifically around landlords' buy-to-let mortgages, where they were nice and easy prior to the 6th of April 2017. But we find that a positive step, because we're opening the doors to a lot of first-time buyers, and they're actually sort of coming back onto the market, and we champion those clients in a huge way. The London market, sort of property market and property values, I would say, sort of dropped slightly. They seem to be stagnating a little bit now. But we are still seeing some wonderful first-time buyers sort of coming to the fore, whether that be London or around the country. Buy-to-let mortgages are getting a little bit more difficult to place. Dependent on whether you, especially dependent on whether sort of how many properties you own. So I think if you own over 4, you're therefore considered a portfolio landlord.
Right.
That's getting a lot tougher, and it is doing the kind of right thing really, and allowing these properties to now become available to first-time buyers, which I think is a hugely positive thing. Brexit, I think, is impacting, or whatever's going to happen with Brexit, we still don't know. I think a lot of people were quite cautious, especially sort of over the immediate 18 months following the referendum. I think now people are getting bored of Brexit and deciding to carry on, as us Brits do. So we are seeing things improve slightly. But as to how the market's going to react, how property prices are going to react sort of now and sort of post-Brexit, we still aren't that sure. But it's nice to see first-time buyers coming back onto the market, and people are starting to remortgage and not necessarily stay and not think about maybe raising some capital and things like that. So we are seeing a positive kind of shift in the market, I think, as time goes on.
So what's on that topic of first-time buyers? What are the key drivers that you think they need to have a good credit report in order to get their portfolio to +4+?
Yeah, so your credit file is very important. And I think when I speak to a lot of clients, whether that's sort of prospective landlords, first-time buyers, general remortgagees, they don't manage their credit profile, or they might just hop on and just look at what their credit score says and think, well, it's a certain level, it's above, say, 800 points, I'm going to be absolutely fine. I think educating people to look at their credit files, one, to make sure everything's correct, because quite often people are open to fraud and they don't know all this is happening in the background, and then suddenly they need a mortgage or some credit and we have some issues. So that's really important. Are you on the voters roll? Is your address correct? Is the spelling of your name correct? Is your date of birth correct? It's all the basic details that we find can lead to blips further down the line should they be applying for a mortgage. Have you paid all your credit on time? How much credit do you have with regard to your income? So it's debt to income ratio. Addresses, financial associations. I personally hop onto my credit file once a month to make sure everything's fine. I have to, obviously, because of my line of work. But also knowing that my information is correct and up to date and is showing correctly. A lot of people do have life happen to them. They may have, late payments or defaults, but it's important that they take ownership of those and actually know that they're there to start with. And to be able to kind of manage that going forward, we always try and assist clients if their credit profile isn't so great now. For example, if they haven't ever had any credit, we can advise them on how to make that a little bit stronger going forward. But I think to know that your credit profile and your information is correct and up to date, I think is very, very important.
Most definitely. And I assume that could swing both ways, whether they're purchasing personally or through a company. Would that be the case? And based on your experience, what is that ratio whereby people buy property on their personal name as opposed to buying it through a company?
We are seeing more, obviously specifically within the buy-to-let arena, you are seeing a lot more people buying through a limited company or special purpose vehicle. And again, still, although you're purchasing or remortgaging through a limited company, they're still doing credit checks on your personal name. So it's as important to make sure that your credit profile is correct and up to date, and just be aware, if you have had some late payments or defaults, always let your mortgage advisor know, because one of the worst things is non-disclosure to the lender. They really don't like that. Yet if we can go to them and say, look, this is the credit profile of the client, they have had some blips in the past, we will ask you why that's happened. It just helps us with our research, but also importantly, it's important to give the correct information to your advisor and also the lenders onwards as well.
Yeah, that's right. Just moving on, one of the things we discussed prior again to us getting together was for you to highlight to the wider audience, some may know, some may not know, but the typical kind of challenges that landlords face in getting a 4+ property mortgage, And also when it comes to perhaps remortgaging a portfolio of 10 plus, the typical kind of financial challenges they may face and how they could overcome those.
The more properties you own, the harder it gets. But that is dependent on how your portfolio, how it actually sits in the background. So a lot of lenders, if you own over 4 or more properties, you are considered a portfolio landlord. They will restrict the loan to value up to a certain amount of properties. So, for example, above 4 but up to 10, you can have 75% loan to value. Above 10, it will be 65% loan to value. Some of them don't assess the portfolio at all in the background. Some of them want them all to sit at 75% loan to value. So that's loan versus lending or mortgage. And they'll also want to make sure that the rental income can service the loan. And that all depends on whether you're a basic rate taxpayer, a higher rate taxpayer. There will be different levels of stress rates. And then, of course, you need to combine that with the portfolio in the background. Every lender is different, which doesn't make our job very easy. So whereas we might be able to tick some boxes with some, we aren't with the others. So, especially when I'm assessing a portfolio landlord case, we will look at the portfolio as a whole, work out what the value is of the portfolio against the mortgage lending on that, what's the rental income, so we can actually assess all of the properties in the background. And that gives us a good idea of the lenders we're able to sort of approach. But the more properties you own, the harder it is to get a mortgage on those, and the higher the rates will be. So you will be looking at 3% above.
And just going back to what we discussed earlier about first-time buyers, what is the best way for someone to embark on this journey as an investor wanting to get hold of their first property?
So the first bit of advice I would give is to see a tax advisor. You should do that first of all before you consider investing in property, because prior to April 2017 it was much easier. You could make more profit on that. It wouldn't necessarily affect your tax liability. Now you need to have an understanding how those tax changes are going to affect you, whether you're a basic rate taxpayer or a higher rate taxpayer. What can you claim against? You need to consider capital gains tax should you wish to sell that property in the future. What other expenses are you allowed to claim on? I don't give tax advice. We have a general idea of what we would ask you to look out for. But the first thing you need to do as a property investor is speak to a tax advisor to understand the tax implications or potential liabilities for you, whether that's personally or whether you want to purchase under a limited company. They are the best people to actually advise you. And there's lots of reliefs and things like that we wouldn't, obviously advise you on. So that would be the first thing. I would also suggest doing a lot of research in the area you're wanting to invest in. Obviously, London at the moment, you would struggle because the rental income won't be enough to service the mortgage. A lot of people are investing up north or kind of on the coastal towns in the south. So just be really savvy about the areas. Speak to some managing agents. What are the rental incomes expected? Is that going to be enough to service your mortgage? A standard buy-to-let mortgage purchase, remortgage will sit at around 75% loan to value. There are some that go to 80%, but again, you'll pay a higher rate. There are stress rates which the lenders ask us to calculate as to whether the rental income will actually service the mortgage. And that's the main route the lenders take in assessing whether the mortgage is affordable. If the rent does fall a little bit short, we can use something called top slicing, which means taking a slice of your income to kind of top up the rental income. And a lot of lenders use that as well. So that's also something to consider. But I would say the first thing you need to do is speak to a really good tax advisor. Be very aware about the area you're investing in and speak to a very good mortgage broker.
Okay, you heard it here, people. Right, so as we were talking, you mentioned second charge. That was one of the services that you provided. Are you able to enlighten our listeners a little bit more on how they benefit of that? I know as an investor, you're faced with whether it's a second charge or first charge.
So second charges have had a bit of bad press in the market before. We used to see very high rates, purely for residential mortgages mainly. It kind of painted a bit of a picture of somebody with adverse credit. You kind of had this avatar of this client that might actually go for a second charge mortgage. We don't see it that often in the buy-to-let mortgage market, but it is available should there not be any other option. Again, we need to consider, so second charges again go on the loan to value. So anything above 75% is going to be very expensive. Your buy-to-let mortgage might already be at 75% loan to value, so a second charge probably wouldn't be viable. So we don't actually see that many in the buy-to-let arena, but it is an option there. Should your loan to value be low, should you be stuck in a fixed rate and you just need to raise some more cash, it is available, but I wouldn't say it's sort of like part of the core lending that we would really do for a mortgage of this type.
Do you see it as a service that might increase in years or months to come as the landscape for property investment is changing?
Perhaps. We've not really seen the lenders budge that much sort of on rates, although with investors who've got 4 or less properties, we're still seeing really wonderful rates out there, very, 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 very competitive. Is really the need for it there? I'm not sure. Second charge sort of lending rates are actually coming down within the residential arena, so, we could potentially see that.
Okay, that's good. Is there anything else you want to add to this discussion?
I think also considering your stamp duty as well. So again, your tax advisor or lawyer, legal advisor will actually advise you on that. So if you already own a residential property and you're looking to purchase an investment property to let out, you will have a stamp duty uplift of an additional surcharge of 3%. So you must factor that into your costs. And a lot of people kind of forget about that. So I think that's obviously really, really important. I think really you need to just, as I said before, do your research, speak to the right people, tax advisor, solicitor, mortgage advisor, and hopefully that will set you on the right path to your buy-to-let lending, now and in the future, whether you have 2 properties or 25. Of course.
Brilliant. Well, thanks very much, Catherine. Appreciate this. If our listeners would like to follow the services that London Money's providing or find out a little bit more about what we've been discussing, where can they search for you on social media?
So we are on the website. That's www.londonmoney.co.uk. I am on Twitter.
Okay.
You can always find me on Twitter as well, LinkedIn. But if you actually hop onto the London Money website, it shows us all. We have our own little bios on there. The photos aren't great, so I apologise. So please come and speak to us. I'm usually in the Independent as well, sometimes asking for their comments. So hopefully you will see me around and about a little bit. But I'm not just restricted to London, it's all over the country. So it's important to let our listeners know that as well.
Brilliant, that's great. And you've also got other colleagues as well that specialise within other areas.
Absolutely.
Do you want to enlighten what those other areas are? Because we're looking to perhaps get them on board as well to the show.
So we have a protection expert at London Money, which is Jiten. He joined us a few months ago. So anything protection, he's your guy. What he doesn't know about protection isn't worth knowing. We've got our second charge arm. So that's Scott at London Money. We've also got somebody for pensions and investments. That's Nick at London Money. We're all at London Money, you see. And anything sort of mortgages and general protection, you can certainly ask us guys. We've also got an equity release guy, commercial. So any mortgage needs you need, any money advice, pension advice, London Money is the place to kind of come really, because we do have an expert in every field. So we look forward to hearing from you.
Okay, and you will do. Thanks very much. Take care. Bye.
Bye.
Thanks for listening to the Property Regeneration Podcast. You can follow us on LinkedIn, Twitter, Instagram and Pinterest, and contact us on contact@propertyregeneration.co.uk for more content and to have your questions answered. Until next time, adopt innovations to accommodate the growing population.